Good afternoon, everybody. Thank you for joining us this afternoon. It's great to have Sally from Together Money online. Hi, Sally.
Hello. Nice to see you all. Not see you all as it is on this occasion. Hopefully here.
Thank you for being with us. And in a second, Sally will go through what Together can do. In the meantime, I'm Dale, one of the directors of Impact. Hopefully you've been on a few of these. We do these on a Wednesday afternoon at 12:30. I've done quite a few weeks. There is a Q&A question button at the bottom of the screen. If you have any questions during the presentation, we'll quite happily attend to those at the end. So please just send over your question and we'll go from there. In the meantime, I'll have some questions at the end for Sally as well. We'll see how time goes. But for now, if I shut my screen, Sally, if you want to start sharing your screen and go from there, and we'll hear what Together can do. Many thanks.
Absolutely, right. Hopefully that's all up for people to see. So yeah, thank you for dialing in today. I am Sally, so the account manager for Together. And I'll follow this up, make sure that you've got my contact details as a point of reference on there. But what I was keen to do really today is just run through our product range following our return to market in September and the USPs that underpin that product range. As Dale says, we'll take some questions at the end if you've got anything. I've put a few extra details on the slides, so if the slides are shared at the end, you'll have some of the detail on there. I usually keep my slides a bit more to a minimum, but on this occasion haven't, just so that you've got a reference point as well. Product guides are also available. So to give you a little bit of background, that Together paused lending in March, quite early on in the COVID situation. And the reason for that is that we wanted to do a thorough assessment of the back book. We've got a lot of bridging finance on there that we wanted to make sure was going to redeem within term and understand what the position was going to be with payment holidays and subsequently with arrears. And we've come back to market in September and delighted to have Impact back on board with us for direct submission. So we've come back to market and we're doing a collaboration just with key partners, and that is allowing us to control the lending that we get in, not only in quantity of lending, but also the quality of the packages that are coming forward. And one of the reasons that Impact have been selected to be on board is because they submit high quality packaged applications to us. And that in turn is allowing us to get mortgage applications through to offer and funding in a really fast turnaround time. And I'm sure you will all agree that in the current market, that is quite a good place to be, and it's quite well received. I'm going to run through today 3 values of Together, and what these are values that underpin our product range. And I'm going to do a quick product update and USPs on each of those individual products if there's some more, and then summarise with a Q&A at the end. So if I first of all talk you through our three values. So the things that underpin our products are client status, so types of clients that we lend to, income, we have quite a unique way of looking at income, and then property types that we will consider. So just to go through each of those in a bit more detail, for status, we lend to UK and non-UK nationals. We lend from ages 18 to 80 and beyond age 80 if it is a self-funding buy-to-let. We have quite a unique way of looking at credit. So we ignore any defaults that are over 12 months old. And we also ignore anything that's under £300. So if your clients have got a blip on a mobile phone bill or something of the like, then that would be completely discounted. And then we work on a demerit scoring basis after that. So on each of our product guides, when I send them out, there is a piece in the bottom right-hand corner which will identify to you what needs to be classed as a demerit. And as a general rule of thumb, up to 2 demerits is acceptable, and you'll find a rate load on each of those products. And finally then, for status, we lend to different corporate entities, so SPVs, limited companies. Moving on to income. So we have a unique way of looking at income and various different income types that we will consider. So we look at clients' total net income. For self-employed applicants, they only need to be self-employed for a year. We can take a forecast with accountant's reference. For employed applicants, we take the PAYE, dividends. They can have 2 jobs and we'll accept both incomes. We accept 0 hours contracts. We will look at the last 6 months average earnings on that basis. And we will also include monthly bonuses and overtime as long as they're evidenced on pay slips. We will look at benefit income, and on applications, if their income is 100% made up from benefit income, then that is also acceptable to us. With regards to our buy-to-let proposition, for unregulated buy-to-let, you can top up the rental income, and there's no limit to the top up that you can use. And then we also use pension income. So if you've got a client, just going back to the first point in status, that will lend up to age 80, once we're lending into retirement, we want some evidence of the pension income that the mortgage was going to continue to be affordable. And then finally, the types of properties that we'll lend on, and this is something that we are quite well known for. I will dazzle you with the next slide of pictures, property types. I'm not going to list all the types of properties that we lend on. I'll give you a bit of a flavour. High-rise, flats, no limit to the number of floors, deck access properties, holiday lets, HMOs, flats above shops, concrete block, non-standard construction, commercial properties. We'll lend on land also. And as a general rule of thumb, I think the thing that you probably need to think about for Together is that if you've got a property type declined, we are the lender that's going to lend on it, as long as you don't teach in it, pray in it, or gamble in it. I think that would be the strap line I would use for types of properties that are acceptable to us. And just going back to those 3 things, we will lend on a combination of those 3 factors. So it doesn't just have to be a non-UK national. It could be a non-UK national that is buying an unusual property type as well. It can be a combination of any of those underpinnings. So moving forward to our product range that we've got, buy-to-let mortgages. So one of the few lenders in the market that have a consumer buy-to-let range. And as I've put on there, 70% loan to value. That is new actually with effect from today. We've made some increases to our maximum loan to values. So up to 70%, no early repayment charges on our consumer buy-to-let product. And the affordability is simply based on rental income on an ICR calculation alone. There's no top-ups on consumer buy-to-let. For buy-to-let, as I say, no restriction to personal income to top up affordability. We lend on HMOs with no limit to the number of bedrooms. Holiday lets, it's a slightly different calculation for how we treat affordability on holiday lets. I won't go into it now for the small amount of applications. It's probably just worth noting to give me a shout so I can run through the affordability calculation on that basis. Your client could be first-time buyer, first-time landlord, and we lend to foreign nationals, expats. There would just be a 1% rate loading for a foreign national expat application. And our ICR is done on pay rate, which at the moment is 6.99. Moving on to our residential product range. So we've got residential first and second charge mortgages. Notable areas for those would be gifted deposits, must be from an immediate family member, right to buy is shared ownership, and the no early repayment charge on those products. No one is coming Together to use us for a 30-year term or to rate chase with us. They're coming to us for kind of reasons as ignoring defaults that are over 12 months old, for example, or self-employed 1-year accounts. So for you as brokers, it gives you a double bite of the cherry that can come to us as a stepping stone lender until they're in a position where they could go across to a mainstream lender. 2 bites of the cherry for you. And commercial loans and mortgages then. There's not a great amount to say really about the commercial loans and mortgages. It does exactly what it says on the tin. I think there's many lenders in the commercial mortgage market, and one of the things that I would say you need to really be considering Together for is the types of property. So there's lenders in that market, but as soon as you say a factory or a farm or a piece of land, it will be declined on that basis, and we will lend on those types of properties. What you'll find is if it is something slightly more unusual, we would restrict our loan to value to maybe circa 50%. Gifted deposits are also available on our commercial product range. Had a case recently which was a bakery being purchased from a family member, and that's absolutely fine, same as on our regulated standard range. And Moving on to bridging finance. So we've got a regulated bridging finance range, and on the product guide, you very much need to stick to what it says on the product guide. There's very little flex on that basis. So loans are from 50,000 up to £1 million. We will do a first and second charge with first charge and second with a cross charge. Pay particular attention to the bottom note on there that the exit on our regulated bridging finance has to be sale of property. I've put inheritance on there, but that's only acceptable where grant of probate has already been issued. And again, maximum age 85 on there. With regards to the unregulated bridging product range, I would use the product guide very much as a guide. There is a lot of flex on that particular product. I've put some key points on there. So loans from 26,000 to 2 million. We are lending above 2 million, but that does need to be on a referral case-by-case basis. We're looking at first and second charges with a cross charge. With regards to rates that are quoted on our rate card, I can't share this part of the screen on there, but it will state on there. So under 50,000 is 0.65%, over 50,000, 0.75%. If we are in competition with another lender, again, send that case through to me, detail the terms that you've been issued elsewhere. We'll happily look at that with regards to rate matching, refer anything that's over £2 million, anything that's a slightly unusual case, absolutely more than happy to have a look at that for you, and we'll issue terms on that basis. Some additional features for us on there is desktop valuation option, both our in-house legal option and the ability to have dual representation. There are some limitations, again, detailed on the product guide in relation to that, but that on top of our ability to give fast turnaround time and service does make us very much a preferred lender in the market at the moment. That case can go through incredibly quickly. You may have seen us shouting on social media about some of them where they've gone through in 3 to 4 hours from application right through to funding. Admittedly, that is not the norm, a 3-hour turnaround time, but you're looking at 24, 48 hours from receipt of a full packaged application for us to be able to take it through. And so to summarise really then, we've got a full product range back on the market. We've got flexibility around our lending, our criteria. I think you'll agree that the 3 key underpinning parts on there give an element of flexibility as well. Our speed of service is guaranteed, and certainty of funds. So those 3 things make us quite a popular lender in the marketplace at present. I would say for your case inquiries, if you initially send them through to myself, if you've got anything that you think initial terms need to be agreed on, or if you're sending them through to the impact guys, they're happy with a lot of our criteria. They're very experienced in dealing with our criteria, and if it's something that's slightly out of the norm, again, they'll refer that through to us. And that leads me on. I've finished well within my super speedy voice to Q&A time for everybody.
Okay, so while we just wait for a couple of questions to come through, first of all, obviously we went together has had a really good relationship with Impact for a long time, a number of years. How does it differ from us dealing with it compared to business coming directly, conversion levels and things, and obviously we've got much more of a sort of certainty decision in dealing with you guys directly, or coming through us, sorry?
Yeah, absolutely. So what the difference now, do you mean between? Yeah,
absolutely. So you're quite limited access because you're controlling obviously the distribution at the moment.
Yeah, so it's not really just about the controlling of lending. So we were lending circa 200 million if you looked per month, if you looked at February of this year, and at the moment we're about a third of that amount. But what we've also done has been a restructure internally and together. There's no secret around that. But one of the things we did is get rid of our pre-underwriting service. So when you have many brokers switched on, I think historically there's something like 1,800 firms, you get a lot of applications in that aren't fully packaged, haven't got the documents, and then they just sit on the system, can't go anywhere, can't be underwritten. So the reason for us having a preferred panel of packages now is that the applications are all coming into us fully packaged to the highest quality, which in turn is now allowing us to lend on a really quick, fast turnaround basis. And I think a lot of people agree that that is a unique place to be in the market at the moment. It's where Together are, it's where we want to stay. So receiving applications through Impact, I mean, you can probably give examples, Dale, of apps that have come in, we packaged it to a high quality, it's in and out the door from our perspective.
Yeah, it has to be as well. We can't have stuff hanging around too long, because it doesn't help our service level agreements either.
Yeah.
And talking about your service levels, you mentioned them briefly. Where are you at the moment?
So for bridging, 24 to 48 hours in and out. Term, fairly similar, I'd say 2 days. The cases are getting looked at same day if they're coming in the morning. But yeah, 48 hours is pretty much an average turnaround time on a case for us.
Okay. And you've obviously changed your criteria today, which is good. Question that's come in, client looking to do a self-build, plot has full planning permission. Is it something you would consider either to buy out the land or even for building the property?
Right, so possibly we look to lend on the land at 50%, but development and self-build is not something that's for us at the moment. We've got a small appetite for development. It's an area of the market that we've been involved in for a long time, but the appetite is not great, and there's some real limitations on lending, original valuation, and plus the build cost. So again, if you think you've got a case that's good quality, more than happy to have a look at that for you. We'll get referred across to the development team, but that's probably an area I wouldn't be considering us for as being one of the prime lenders in the market at the moment.
Okay, another question that's come in, as you mentioned, valuers, actually this brings us along nicely to this question as well. Are you seeing many issues with property valuations at the moment, and are you accepting properties with cladding?
We are accepting properties with cladding, but we do require the EWS 1 certificate.
Yeah. And
I will put a little addendum on there that we need it to confirm that it's satisfactory. I got one in the other week where it confirmed that it was unsatisfactory, and the argument was, well, we've given you the EWS 1 certificate. I'm like, you've given us the certificate that confirms it's not satisfactory. So we're not lending on them for a non-satisfactory basis. If it is declared satisfactory, then yes, no issues with that. With regards to valuations, no, I've not seen many cases with valuation issues. I think that's something that's been ironed out quite heavily through the summer, really, with regards to.
Yeah, absolutely. Okay, and what's your views on how you dealing with the self-employed at the moment?
So
are there certain areas of the self-employed market that you're just not dealing with?
No, what we are looking at though is we've enhanced, I guess, the underwriting criteria at the moment, that we're looking at realistic earnings from April 2020 to date. So we are looking at accounts from April 2020, but we want to confirm that that income has continued at that same level and been sustained. And that's on both sides, actually, because we had an app in from somebody involved in PPE industry. Their income's absolutely flown for obvious reasons this year, but neither do we deem that that is a sustainable income based on their income from April to date. We are then looking at what their income had been for the previous tax years to give us a more realistic figure of how we should be assessing that. So I would be suggesting that not only looking at previous accounts, but also looking for realistic income figures that have been earned in the last 6 to 9 months. And we'll be asking those to be verified with an accountant's reference.
Sure. So we're looking at projections and especially what sort of type of area they're servicing at the moment. And sort of areas, what are you going to do with regards to tier 3 lockdowns? Are you finding valuers are accessing properties okay, or are people being turned away?
No,
I heard anything at all.
Been aware of with valuers. I think I'm possibly less party to knowing about that, because I'd see the application at the point where it comes in to be fully packaged. So you're probably a better guide when you're submitting the applications to be aware if there are any valuation issues, because you'll have done that before I even potentially get sight of it. That's, I can say that from having case inquiries through to receiving the fully packaged application, that doesn't indicate that there is an issue in that regard.
Okay, that's good. From my point of view, what tips are you going to give people, especially if they're not in this area of the market? What tips do you give brokers at the moment?
And sorry, can you just clarify what you?
Yeah. So what advice would you give a broker who's not in this market at the moment to really pan out, go and find clients in this area? Because there are going to be a lot of people at the moment, a lot of clients who are burying their head in the sand, hoping that they will, that their issues will go away when obviously they won't.
Yeah, I mean, I think brokers are incredibly busy, it seems to be, with clients. I certainly wouldn't be binning any leads that you've got. I mean, there's ourselves and lots of other specialist lenders out there in the market. So if you've got a case that you're finding a bit tricky, then Impact need to be the point of contact. You're the expert in all areas of lending. So if you've got cases that you think are not normally placeable or not placeable in the current market, I would very much dispute that and say that they need to be making those inquiries, forwarding them to somebody who's got the right and relevant expertise in that area. And it could be that you don't help them historically with a case in a particular area. It might have been a second charge that they're not doing. So if they've got that point of contact with Impact and have got something new across the desk that they think is not quite the norm.
This is where Together comes into their own, especially with regards to the property types that you will take into account, which is great. Another question come in. They have a client that owns 25 commercial units, a mixture of business within a shopping centre, owned through a limited company. Total rental income is about $1 million a year, valuation approximately 10 million. They're looking to raise funds. Would Together consider this one?
So on a term loan, is this, or on a bridge? I can't see the.
Doesn't say. I would say probably on a term loan by the looks of things.
Yeah. I wouldn't say it's an out and out no, but our maximum loan size on commercial term is lower than it is on bridging for ourselves. If it is something that is a reasonable loan to value and the rental income can be proven, I think with shopping centres at the moment, we'll be paying extra due diligence around making sure that those rentals have been paid. Retail industry has been massively hit during 2020. But again, if you've got a case of that nature, we are a commercial mortgage lender, so more than happy to give it a once over. I don't have the authority to be lending up at that kind of loan size, but I obviously have the contacts that would make those decisions. So LTV are up to date.
Yeah, I think from our personal dealings with Together, I think if there is a reason to do the deal, then normally 9 times out of 10 there is a way to make that deal work for both the lender and for the client as well.
Yeah, I mean, we absolutely brand ourselves as a common sense approach to lending, and that is so. There's not a firm and straight answer to be able to give on that type of query, but that's exactly what I'm here for, what Impact are there for as well, for those kind of case inquiries to come through to see if it is suitable. Yeah.
A couple of minutes left to get your questions in, so please do type quickly if you're going to do that. In the meantime, we'll just wait for those to come through. Sally, what's your thoughts for 2021?
Oh, I'm hoping these green shoots are they seem to be showing. I think the vaccination has been huge news. It feels this week like someone's trampled on those green shoots a bit with the expansion of tier 3 and what the potential impact of that is going to be. I think in the wider field, the concerns about so if I go back right to my original point about why we left the market, to understand the back book, and the reason we've come back more cautious is because there is an element to that at the moment of payment holidays and mortgage arrears, and I don't think we've seen the true picture of the potential for unemployment and mortgage arrears, but the green shoots are showing that there are, fingers crossed, some improvements to the world, to the market. I mean, certainly for the UK anyway. I've seen an incredible amount of inquiries since we've come back to market. It seems like things were sitting on desks for a period of time throughout the summer. Either we weren't the only lender that were out the market, and I think we've been gratefully received back to the market, and we haven't come back with any big changes to criteria. So we're still lending to the same type of clients, we're still lending on the same type of properties. We haven't made big changes with that. We did some slight restrictions on loan to values initially, but you'll see from the amendments that came out today, certainly on the personal finance, the regulated side, we've taken that back up to 70%, whereas we came back at 60%. We were quite cautious around that to start with. So hopefully with the wider world looking like it's going to be improved, that 2021 is, I'm hopeful, going to make up for what a poor year 2020 has been for many.
Let's hope so. Fingers crossed. From my point of view, I think it's customer education. Everything. People bury their head, and it sounds like I've said. They hope that their issues will go away. That's where we need to be absolutely, whether it be ourselves as brokers, mortgage packagers, distributors, lenders, even I sit on the AMI industry contact group, and we're trying to get out to customers as much as possible. Don't sit there, don't bury your head. Try and get your requirements sorted to meet your needs, because if you can't afford your monthly payments at the end of the day, you need to be sourcing that, and it will come right.
And it does make sense to have this extra piece of due diligence around. So we made on our employed clients, for example, we changed criteria where we said they must now send us also an employer's reference, which just confirms they're not part of a government scheme, because we're not accepting furloughed applicants, and that they're not at risk of redundancy. So you take that due diligence now, I think is a responsible approach, making sure that customers can afford the mortgages that they're getting in for. I guess the good part for us is that if there have been some blips this year in 2020, quite early on in COVID, by the middle of next year, when they're over a year old, again, we'll be the lender on the PF products that will be ignoring those for them to be able to come through on the mainstream rate.
Cool, thank you. That actually brings us nicely to a close. So thank you, Sally, appreciate that. I think that's been a really good insight.
Thank you very much for having me on. It's nice to see you.
You're welcome. What we'll do is we've already put today's changes on the Impact website on the packaging side. So go to impactpackaging.co.uk. You'll see all the together changes and the latest product guides and so on. In the meantime, if you've got any inquiries, like Sally said, give us a shout. Numbers on the website. Give us a shout. Speak to the help desk, and as we need to, we get in touch with Sally, trying to get things through and exceptions and so on. So we're all in this together to help the customer at the end of the day. Thank you for watching. Appreciate your time. I appreciate you watching these on a weekly basis. If we don't speak to you beforehand, have a fantastic Christmas and a very prosperous New Year, and we'll catch up with you very, very soon. Take care and keep well.